In January 2021, a video game retailer that was supposed to die became the most traded stock on Earth. Hedge funds lost billions. The financial establishment panicked. And then it was over. But something else started happening in the background. A metal that's been around for 5,000 years suddenly became the center of the most ambitious coordinated buying campaign in modern history. Not by institutions, not by governments, by millions of people on the internet who believe they've found a crack in the financial system so large, so obvious, that the only question is why no one tried to exploit it before. They call it the silver squeeze. And if they're even half right, what's about to happen won't just move markets. It'll expose how much of what we call wealth exists only because we all agreed not to look too closely at the math. This is that math. Let's start with what actually happened with GameStop, because most people got the story backwards. The popular version goes like this. Reddit found a dying company, pumped the stock, and screwed over some hedge funds for the memes. Chaos, profit, justice. Roll credits. But that's not what made GameStop dangerous to Wall Street. What made it dangerous was the squeeze. See, hedge funds had shorted GameStop. They borrowed shares, sold them, and waited for the price to collapse so they could buy them back cheaper. Standard play. Happens every day. Except this time, they shorted more shares than actually existed. GameStop had about 50 million shares outstanding. Hedge funds shorted over 70 million. They sold something they didn't have, betting no one would notice. Wall Street bets noticed, and they realized something beautiful. If enough people bought the stock and refused to sell, the hedge funds would eventually have to buy it back at any price. Supply and demand weaponized. It worked. For a few weeks, a group of retail traders with smartphones held some of the most powerful financial institutions in the world hostage. Then the brokers shut it down. Trading was restricted. The squeeze deflated. GameStop fell. The system survived. But the idea didn't die. It migrated to silver. Here's what the silver squeeze believers figured out. Silver isn't a stock. It's a commodity. It's been money longer than any government has existed. And unlike GameStop, it has something rare in financial markets: actual industrial demand that keeps growing. Every smartphone has silver in it, every solar panel, every EV battery, every 5G tower. The world is electrifying, and electrification runs on silver. But here's where it gets interesting. There are two silver markets. One is physical, real metal you can hold. The other is paper, contracts, ETFs, futures. Digital promises that silver exists somewhere. And just like with GameStop, Wall Street sold more paper silver than physical silver exists. A lot more. The most popular silver ETF, ticker symbol SLV, claims to hold 900 million ounces of physical silver. But if even a fraction of shareholders demanded delivery, the whole structure would collapse because the silver isn't there. Not all of it. It's the same game, naked shorting. Except this time, it's not 70 million phantom shares, it's hundreds of millions of ounces of phantom metal. And the price has been suppressed for decades by banks trading paper contracts back and forth while the physical market tightens. Wall Street bets looked at this and thought, if we did it to GameStop, why can't we do it to silver? Buy physical, drain the vaults, force delivery, break the paper market, squeeze the banks the same way we squeezed the hedge funds. To understand why this could actually work, you need to understand the COMEX. The COMEX is the commodities exchange where silver futures are traded. It's where the price of silver is set, not by mining companies, not by jewelry buyers, by traders in New York, moving contracts that represent silver stored in warehouses. Each contract is 5,000 ounces. You can buy one, hold it until expiration, and demand delivery. Most traders never do this. They just settle in cash. That's how the system works. But what happens if everyone demands delivery at once? In March 2020, it almost happened by accident. COVID hit. Refineries shut down. Physical silver became hard to get. The paper price on COMEX was $16 an ounce, but if you wanted to actually buy a silver bar, dealers were charging $25, $30, sometimes $40. The paper market said silver was cheap. The physical market said there wasn't any. That gap, That's called a disconnect, and it's not supposed to happen. If it gets wide enough, someone will arbitrage it. They'll buy paper silver, take delivery, and sell the physical for profit until the prices converge again. Except in 2020, they couldn't, because there wasn't enough physical silver to deliver. The COMEX changed the rules. They allowed cash settlement instead of delivery. Problem solved for them. Wall Street Bets remembers, and they're trying to force it to happen again, except this time on purpose. So here's what the silver squeeze movement is actually doing. They're buying physical silver, coins, bars, rounds, anything they can get their hands on. The goal is simple: remove supply from the market until the paper price can't be defended anymore. And it's working, sort of. In early 2021, silver bullion dealers ran out of stock. Premiums spiked. Mints couldn't keep up. The US Mint, the Royal Canadian Mint, Perth Mint, all of them either delayed shipments or stopped taking orders entirely. But the COMEX price barely moved. It jumped from $25 to $30, then fell back. Meanwhile, if you wanted to actually buy an ounce of silver, you were paying $35, $40, $45. The disconnect was back, and it's still here. Walk into any coin shop right now and ask for silver. If they have it, you'll pay $8 to $12 over spot. That's not supposed to happen in a functioning market. So why hasn't the squeeze worked yet? 3 reasons. 1, the COMEX has more silver than people think. Not unlimited, but enough to delay a crisis. 2, industrial users can recycle silver. It doesn't disappear. 30% of supply comes from recycling. If the price spikes, more gets recycled. 3, the banks can suppress price by shorting futures contracts without holding metal. They can create infinite paper silver. As long as no one demands delivery, the game continues. This is the core problem. The silver squeeze can drain retail supply. It can make coins expensive. It can create shortages at dealers, but it can't force the COMEX to run out, not unless industrial users, sovereign wealth funds, or other institutions join the hunt. And so far, they haven't. But let's say, hypothetically, it worked. Let's say enough people bought physical silver that the COMEX couldn't deliver. What happens then? First, the price would spike. Not to $50, not to $100, higher, because every short contract would need to be closed. Every ETF would need to find metal. Every industrial user would panic buy inventory. Silver would stop being a commodity and start being a crisis. Mines would ramp up production, but it takes years to open a new mine. Recycling would increase, but you can't recycle what hasn't been sold yet. For a brief window, there would be a genuine shortage of a metal the modern world depends on. And that's where this gets uncomfortable. Because silver isn't just an investment, it's infrastructure. Medical equipment uses silver, water purification, electronics, renewable energy. If the price goes parabolic, supply chains break. Not for luxury goods, for critical systems. Wall Street Bets would win, the banks would lose, and the collateral damage would hit everyone who didn't know this game was being played. That's the trade-off. You can break a manipulated market, but breaking the market doesn't mean you get to control what comes next. Now here's the uncomfortable question no one in the silver squeeze wants to hear. What if the banks aren't manipulating the price down? What if the price of silver is exactly what it should be, given supply, demand, and substitution effects? Gold is 8 times rarer than silver, but costs 80 times more. Why? Because humans decided gold is money and silver is industry. You can argue that's irrational. You can argue silver is undervalued, but you can't argue the market into agreeing with you by force. GameStop worked because the shorts had a time limit. They borrowed shares and had to return them. The squeeze had a deadline. Silver has no deadline. If you buy a silver coin and hold it, you're not squeezing anyone. You're just holding a coin. The banks can keep trading paper. The COMEX can keep settling in cash. The system can ignore you, unless millions of people do it and keep doing it for years. That's the problem with revolutionary financial movements. They require sustained coordination, and the internet doesn't do sustained. It does viral, then it moves on. So where does that leave us? Silver is the second most discussed commodity on Earth right now. Bullion dealers can't keep inventory. Premiums are at historic highs.
And the COMEX price acts like none of it matters. Either the squeeze is working slowly, and we're watching the early stage of a system breaking in real time, or it's not working at all. And what looks like a revolution is just a very expensive hobby for people who bought metal at the top. The truth is probably somewhere in between. The silver squeeze revealed something real. The gap between paper and physical is wider than it should be. The system is leveraged. The price is set by contracts, not metal. And if enough pressure builds, something will give. But revolutions don't happen because someone on Reddit said so. They happen when the incentives align, when institutions see profit in chaos, when governments see advantage in disruption. Retail can start the fire, but it can't control the burn. Wall Street bets tried to break the silver market. They haven't succeeded yet, but they did prove it's possible. And now, everyone's watching to see who tries next.